Depreciation and its methods, brought to you by APOOL. Accounting Pool or APOOL is a subcommittee of JPIA. APOOL is a group of JPIA members who devote their passion to teach other members who has difficulty in a particular accounting subject. In collaboration with COB Channel, JPIA through APOOL has decided to choose a topic that encompasses most of the essential principles of accounting in order for them to truly appreciate and understand the wholeness of accounting. Let's start with the basics. Depreciation, as defined, is just a reduction in the value of an asset with the passage of time. Note that it occurs due to wear and tear. It means that as time goes by, our assets eventually reduce in value. So does it mean that all assets which are useful for long periods of time are subject to depreciation? Well, theoretically yes. However, in accounting, the first concept of judgment comes in. It is called the materiality. An information is material if its omission or misstatement could influence the economic decisions of users taken on the basis of the financial statements. So with regards to the depreciation of assets, not all assets with long periods of useful life are capitalized, since expensing them does not influence or affect users' decision on the financial statements. Let us assume that a very large company made the following purchases this year. One is a bike for the use by the delivery man to run small errands, while the other one is a car for the use of its CEO. In this case, both of these assets have long periods of useful life, but the company accountant decided to expense outright its purchase of the bike since the amount is immaterial, as compared to the purchase of the car, which was capitalized. The entry to record each transaction is as follows. For the purchase of the bike, debit miscellaneous expense and credit cash for 6,500. For the purchase of the car, assuming a 20% down payment of cash, the entry is debit machineries and equipment for 1,358,500, credit cash for 271,700, and credit mortgage payable for 1,086,800. Note that for the purchase of the bike, it was easy for the company to purchase it all by cash, that's why it was charged to an expense account. While for the purchase of the car, the company capitalized the whole amount which was paid through the down payment of cash and the balance to a mortgage. Are there other capitalizable costs? Yes, there are, and they are called the incidental costs for the machine. Typical capitalizable costs include freight-in, custom duties, installation costs, commissions to broker, and testing costs. So far, we have already discussed what depreciation is, what we depreciate, and why we depreciate. Now, let us talk about how we depreciate. These are the important terms that we need to know in computing depreciation. Acquisition cost includes all costs incurred to bring the asset to its intended use, which is capitalizable costs less discounts granted, whether taken or not. Following the net method, it assumes that any responsible company would pay early to take the discount. Depreciable cost is the acquisition cost, the salvage value. Salvage value is the estimated resale price of the asset at the end of its useful life. This means that normally, if the asset has a salvage value, the company has the intention to sell it at the end of its useful life. Finally, annual depreciation may be computed depending on the depreciation method used. Here is a typical illustration. The company purchased a machinery on January 1, 2011. Given the information on the right, we are to find the following: acquisition cost, depreciable cost, and total expenses. The invoice price of 3 million less discounts granted of 7,000 plus freight-in of 100,000 plus installation cost of 9,000 gives us the acquisition cost of 3,102,000. The salvage value of 5,000, we will get the depreciable cost of 3,097,000. If we add the accidental repair of 20,000 and the annual maintenance of 10,000, we will get the total expenses of 30,000. Remember that accidental costs are not necessary costs, and annual maintenance, although necessary, are incurred normally to maintain the asset's condition after it starts operating. In order for it to be capitalized, it should bring the asset to its intended use. These are the methods of depreciation. The straight line method has equal allocation of depreciation using the useful life of the asset, and it uses the salvage value. The sum of years digit is a form of accelerated depreciation using the summation of the numbers of useful life. It also uses the salvage value. The double declining balance is an accelerated depreciation using a standard rate multiplied by the carrying amount of the asset. This does not use the salvage value. Continuing with our example earlier, we just divide the depreciable cost of 3,097,000 by its useful life of 10 years. We will get the annual depreciation of 309,700 pesos. This is using the straight line method. What if the purchase was dated August 1, 2011? In this case, we will depreciate the asset for only 5 months. Note that the annual depreciation is different from the depreciation for the year unless the purchase was made at the beginning of the fiscal year. If it is bought during the middle of the year, the depreciation for the first and subsequent years will be different. So for this example, we just multiply the annual depreciation of 309,700 by 5 over 12 to get the depreciation for the year of 129,041.67. Assuming the asset was purchased on August 1, 2011, how much is the asset on July 1, 2021 and on August 1, 2021? To get the carrying amount on July 1, 2021, we need to deduct the accumulated depreciation from the acquisition cost. Accumulated depreciation is the cumulative balance of depreciation up to a single point in its life. In this case, we multiply the annual depreciation of 309,700 by 9 plus 11 over 12. Notice that the annual depreciation for the last year is allocated to 11 months. To get the carrying amount at the end of its useful life, which is on August 1, 2021, we deduct the monthly depreciation from the carrying amount we computed on July 1, 2021. Notice that 5,000 was also given earlier as the salvage value of the asset. The sum of years digits method follows the formula depreciable cost multiplied by the remaining useful life divided by the sum of years. The sum of years can be computed by using the formula n times quantity n plus 1 all over 2, in which n is the useful life. Continuing with our example earlier, using the useful life of 10 years, we would get the sum of years of 55. This is a schedule for the sum of years. At year 1, the remaining useful life of the asset is 10 years. Following the equation, we multiply the depreciable cost of 3,097,000 by 10 over 55 to get the depreciation of 563,090.91 for year 1. Notice that the annual depreciation in the sum of years digits method decreases every year unlike in the straight line method. What if the purchase was dated August 1, 2011? Using the sum of years digits method, we will just allocate the depreciation for year 1 for 5 months to get the depreciation for the year of 234,621.21. Assuming the asset was purchased on August 1, 2011, how much is the asset on July 1, 2021 and on August 1, 2021? In this case, we have to compute for the accumulated depreciation at year 9 and deduct it from the acquisition cost to get the carrying value of 61,309.09. But this is just the carrying value on August 1, 2020. We are looking for the carrying amount at July 1, 2021. So we need to include the depreciation for the last year by allocating the depreciation in year 10 for 11 months. To get the carrying amount on August 1, 2021, which is also the end of its useful life, we just deduct 1 month of depreciation from the carrying amount that we computed on July 1, 2021. Notice that 5,000 is the salvage value of the asset. The double declining balance uses the formula carrying amount times the declining rate. The declining rate is 1 over the useful life times 2, hence the term double declining. So using our original example, we will get a declining rate of 0.2 or 20%. Notice how this method does not use the depreciable cost but rather the carrying amount of the asset. This is the schedule for the double declining balance. Notice how the total depreciation does not add up to the depreciable cost since it did not account for the salvage value. An accountant may depreciate the asset to its salvage value at the end of its useful life. The carrying amount at the beginning of the year multiplied by the declining rate of 20% gives us the annual depreciation for year 1 of 620,400. For the depreciation at year 2, we use the carrying amount at the end of year 1, which is 2,481,600 times 20% to get the depreciation of 496,320. Comparing this method to the sum of years digits method, double declining balance is actually easier. If the purchase was dated on August 1, 2011, we will just allocate the depreciation for year 1 for 5 months to get the depreciation for the year of 258,500. To summarize, the depreciation in the straight line method remains constant all throughout the life of the asset, while the depreciation in the sum of years digits and the double declining balance decreases through the years. This is the graphical representation of the three methods. From this chart, we can see how the straight line method is just consistent with the depreciation per year, while the sum of years digits is accelerated on a sloping line, while the double declining balance is curving.